Go on.
All right. Thank y'all for having me. As always, how's the sound? Good? Maybe it's good to trust that it's
I'll trust it.
everything. Good surround sound. So, thank y'all for having me. Again, David Brown's here at Pacific Mortgage. Our trustee processor, Jessica Williams, who makes it all happen behind the scenes. I think it's good to kind of put a face with the name. And
We need a face with the name, Jessica, please.
yeah. So it's time for you to get your. No, I'm just kidding. But Jessica and I work closely together every day. We just moved to our new office over on Oakland Avenue. We're just kind of around the corner. We're excited to be there, as opposed to working from home as we did for a couple months between offices. So come by and see us sometime. So we are, when we do these, we're always thinking about what's new, what will be of interest to you, valuable. I would really want to hear from you guys too, hear kind of what you're seeing out there, and that will help us as we're serving you guys. So a couple of topics that we think are of interest these days. We're seeing all the data we hear and read about transactions right now while they're down. So many of them are cash. Probably roughly a third of transactions. Some title companies I've talked to said more like half, which is just crazy, are cash. We can't help those folks, unfortunately. So we can't help our buyers, with competing against those offers to a degree. So how can we get better at helping our clients who need to borrow money in order to win that purchase transaction, that bid? And I know it's becoming a little less competitive, but I know they're still pretty hot among buyers. So got some flyers that we generated to talk about how we're now offering true pre-approvals. So historically, I know when you talk to lenders, you hear the terms pre-qual, pre-approval kind of interchangeably. A lot of people think that that's one and the same. I know a lot of you guys have been around for a while, know that there's a difference. So what is that difference? When we're pre-qualifying someone, what goes into that? We're taking an application. Now there are lenders out there who will just generate a pre-qual just to get it out the door. And I'd be lying if I said I've never done that before. But ask a few questions, kind of get the feel. If you need one, just immediately, sometimes you do that. Now that's a slippery slope, I think. If I'm putting my name on something, say this person is credit worthy and they're able to buy, I want to make sure they're able to buy. Traditionally, a pre-qual would involve running their credit, asking about their income, their employment, the structure of their income, how they're paid, their assets, what funds do they have that will be able to put down, or if it's a 100% program, what are the funds they have to go towards closing costs, what's the source of those. We're really trying to understand where the money's coming from. And it's all verbal. We're asking questions, they're telling us, and we're taking their word for it, and we run it through, and if it checks all the boxes, they're pre-qualified. Okay. A pre-approval really takes it a couple steps ahead, and there's been kind of informal pre-approvals over the years where maybe we'll collect a pay stub or maybe collect a bank statement to really substantiate what they have. But I think now we're seeing companies like ours kind of take that next step to actually have a formal process to pre-approve that borrower. So we're not just eyeballing a pay stub or a W-2. We're actually saying, hey, for us to pre-approve you, we need all the things that an underwriter is going to require to issue an actual formal approval, so that when we get a contract, all we really need at that point is an appraisal and title work, essentially. So we're doing the verification of employment. We're collecting their income documentation. We're actually sending all this up to an underwriter to review the file, verify employment, actually taking those steps to make sure that they are that they're qualified. Because there's a big difference in a loan officer or the salesperson, reviewing this and kind of checking the boxes, and then an actual underwriter double checking to saying yes, you're right, or saying, hey, I know you calculated income this way, but we have to calculate it this way, or maybe there was an employment gap, or maybe there was maybe there was some variable income that they haven't yet been doing that for a full 12 months or 24 months or something. So all these little nuanced things kind of helps us make sure that we're overcoming those potential pitfalls on the front end. So what that does, I think, for buyers and for agents, it says, hey, we've got a truly pre-approved buyer that, assuming they find a house that's eligible, appraisal, title, they're good to go. So it cuts our turn time down to what, 10 to 12 days, 10 to 15 days. We've got an appraisal waiver, maybe even shorter than that. So I think there's value in that right now, where you're going up against cash to say, hey, we got a buyer who actually is ready, ready to go as far as the underwriting process. I've heard many times where deals fall through to financing. Seller sells house back on the market due to no fault of their own. Seller financing fell through. It happens. So that's I think that's something we're hearing more and more from buyers, that's important, and agents. We now have our IT departments overhauled our application process. Now we can hit a couple buttons and shoot it off. Turn times was what, Jessica?
About 2 days.
About two days on getting that back. And they're coming back to us. They're saying, hey, we need, we're not getting a VOE, or we're not. So there's, it really is a detailed process to make sure that we're checking all the boxes. So, and I think that's what buyers want. They want the confidence to know that, if they find that house, they're good. Any questions about that?
Can you speak more into the process of, I know you said you have the loan officer, the salesperson, and then as opposed to a pre-qualification and a pre-approval. I think even a lot of realtors that we speak to, or especially buyers, they think you're the guy.
Yeah.
That you're the one that if anything happens, they're like, why is he asking for this again? I don't understand. And they don't know that you're giving this to an underwriter who's reviewing things. And, well, this guy told me I'm fine. Can you speak into that relationship?
Yeah, and I think that's the value of having someone who's experienced, and a loan officer who's experienced. Now, we as loan officers, we're out doing what we're doing right now. We're out selling, building relationships. Our job is to, like what you guys did to generate leads. You've got a funnel. You're trying to throw leads in the funnel that funnel down to close. We aren't expected to know everything there is to know about every loan program. If it gets to a point where we should have known something, then it comes back. It's like, okay, well, maybe we should have known that. We need to know enough about all the different programs to kind of be dangerous, right? And if we have questions, we know where to go to get an answer, who to call, and we have all those resources internally for that. But a loan officer is not making a decision on a credit file. They're just not, and it's probably a good thing. If I could make a decision on every client that I was working with, there could be some more losses down the road. Because we're paid a commission, and that's just how it works. So those checks and balances, we get a file, we put it all together with all that we know about the situation and the borrower. We based on our experience, we know what to ask for. We get that information, we put it all together, and we shoot it off to underwriting. Well, then they review it, and that's what they do all day, is review files. They know the guidelines much more than we do. And those guidelines are always changing, so there's always something changing with requirements, and they're reviewing documents at a much more granular level than we are. So, for instance, if I ask for 2 months of bank statements, I probably don't have the time to go line by line with those bank statements. I just don't have the time or capacity to do that. Now, Jessica might catch something. She might say, "Hey, we had a large deposit that we don't really know where that came from. We need to source that." That's what an underwriter's going to do. They're going to catch things like that. When I'm getting income documentations, I'm not going through a tax return page by page to see every source of income, or I'll glance at it if something jumps out. I might ask the borrower about it. But I'm not going to take the time to go through it like an underwriter will. A pay stub, I'm not going to look at every little. There might be a child support line item on a pay stub that they didn't disclose it on the front end, and now we have to go back to them and say, hey, we need to understand this. How long been for? How much? We need more documentation to support this. So it's very common in our world to have to go back to a borrower for more information, just because everyone's situation is totally different, and you know, there's a million things that can pop up that maybe that you don't find out on the front end. Does that help, Matt?
Yeah, that's it. You'll have to watch the recording.
So, you know, we have really good underwriters. We work closely with them. They're very approachable. They're very responsive. And then we have, you know, managers we can go to if we need to arbitrate, if we have a disagreement. We, you know, I think, you know, with the situation we had not too long ago where we went back and said, hey, I don't know that we agree with this, or why do we need this? And if you challenge them, sometimes you can not have to, you know, get what they're asking for. So that makes things
Sounds great.
so, yeah. So, do I need to say all that again?
No, that's perfect.
Okay. So anyway, yeah, underwriters are, you know, and I think having a team of underwriters who are pro getting deals done is important. They're not looking for reasons to turn down a deal, but looking for reasons to approve a deal and get it across the finish line. That's, you know, we found that to be the case this year. So I think we're fortunate in that regard. So, what other kind of questions you guys have?
I have a scenario where a client went online, had a local lender here, went online and found somebody else
Mm-hmm.
and got, you know, better rate
Right.
and less closing costs.
Yep.
But able to get a sit-down meeting with them, with the local lender, and they were able to match
Mm-hmm.
the outside.
Yep.
That's something that, I know it can't always be done, but
Yeah.
as an opportunity is getting you in front of them rather
Mhm.
than on the phone and going through
Yeah.
email things, but actually sit down and say, hey, let's really go down through this and see if we can help you
Right.
get in a better spot, or even just better understanding sometimes. I
Mhm.
mean, that was the situation. I just don't think the communication was working through the phone and email.
Right.
It would be
Yeah.
like right now, to go face to face
Yeah.
and talk things over.
Yeah.
That's something that I think is helpful. That's something that you'd be able to.
Oh, of course, absolutely. I mean, yeah. I mean, if you can. So, I mean, technology has changed how we do business in a lot of ways, for the worse, because we don't have as many face-to-face interactions. But I welcome that.
Can you kind of restate what you said?
Let me restate the question. So, yeah, I mean, so I think my question, and tell me if I'm wrong, is there's clients who value having someone local
Yeah.
who they can go into and talk to or meet face to face and have them walk through closing costs, the process, all these things. And you don't get that with an internet lender or out of town lender. It would probably be similar to what you guys do, having to deal with someone out of state or something. Not everyone values that, but there's a lot of people that do. And we welcome that opportunity to sit down with someone face to face and just go through in person. You know, we'll send a lot of times loan estimates or fee estimates, and we don't have the luxury of, we can do a Zoom or something like that. We don't always have the luxury of going over with them, and you know. So yeah, we love that. I mean, that, you know, if we ever have a chance to do that. Internet lenders, their cost structures different. Their personnel situation is different. You know, they're generally going to be cheaper if you look apples to apples. The person in that cubicle in Detroit or wherever they're working out of is probably working with a lot more files each month. So they have a higher volume. They're probably being paid a lot less, and so it's a volume game for them. They may not have been in the business very long either. There's a wide range of lenders out there when you're talking about like the internet lenders, right? They're trying to keep their costs way down, and they're trying to deliver almost a wholesale type of transaction. It allows them to price their loans lower. They're paying their people less. They got less costs. They're putting more volume on their people. what we found time and time again is that when there's a bump in the road, that person not having really any skin in the game to return calls, emails, they're not available after 5 o'clock on the weekends, and there's just a service level that's just much different. So I had this conversation this morning with someone. I think a lot of times people look at what we do very two-dimensionally. They look at a fee estimate or a loan estimate, and they see the value in what we do on that. Just like with you guys, they look at 3% or 2.5% or whatever. Like that's the value, and they're not taking into account experience, communication, responsiveness, making sure that this isn't a nightmare for the next 45 days, 34, right? And a lot of people who haven't bought homes before, or they've had 1 or 2 transactions that went fine, they just don't see the value. They don't see the value in having someone locally who can really walk them through that. So some people will see that value, some people won't, and so we're not for everyone. I mean, we're just not. I mean, we're not the low cost leader. We're not the low cost provider of what we do. Just like I know you guys aren't either. So, but for the client that puts their trust in you guys, puts their trust in us, to hold their hand through the whole process, and they're willing to, not pay a high rate, but pay. Maybe a little bit more than what they find online. That's a wonderful opportunity for us. So, and we can show our value that way.
Yeah, I agree.
Good question.
Plus, some of those questionable places, people have to be careful to find somebody online that's reputable.
Yeah, for sure.
I mean, some of them can be like a scam.
Yeah, in our industry, there's a lot of bait and switch. I mean, there's a lot of advertised stuff that, once you get into it and give them all your information, and once they have you a little more on the hook, then things change. And then at that point, you're a little too far down the road to where, you can correct course. So that's unfortunate. But, regulation, I think, has helped a lot of that. But, if you go to lendingtree.com or Bankrate, you look at the mortgage rates, and I can guarantee it, there's some really low stuff out there right now. If you read the fine print, though, it's a pretty narrow box to start with. And then once you get in the process, and they get your information, that's when things change. And, I'd much rather be on the front end and let people know what to expect, and not have to go back and backtrack and justify why it's different than what we talked about.
Yeah.
Talk about that bait and switch as far as somebody saying, I can offer you a 4.5% interest rate. Interest rate now 4.5%. You can do that.
Yeah.
But how do we get there?
Right. So there's probably some fees, discount points that are in there. There might be some. It might be a lock period that's a lot shorter. That's not realistic. I mean, there's a lot of. And the question is can we offer low rates a lot of times? Yeah, but there might be extra fees that go with it.
I don't think a lot of people see that. The rate is offered.
Yeah.
Like you said, two-dimensional.
Right.
This is what I pay.
Right.
And a lot of times folks are kind of confused about closing costs. They always think they can always wrap it in no additional cost.
Right.
Doesn't make sense when you start doing math on both sides.
Right.
But they're just like, oh, I'll just wrap it in.
Right. There are a few programs out there that do allow for rolling in closing costs. I know, we don't. Let me think. Now, some of the government loans will allow you to roll the funding fees in. There's some down payment assistance programs we're working on bringing in that'll roll some of those in. But by and large, either the borrower needs to cover the closing costs or negotiate with the seller on the seller paying some of that. And there's limitations on what the seller is allowed to pay. So on a conventional loan, if they're putting 3 or 5% down, the seller is only allowed to pay 3% towards their closing costs. Hopefully that covers it all, but sometimes it doesn't. If they're buying the breakdown, that kind of thing. So, yeah. Good question. What else? Just a little about this. that's kind of a segue into ARMs, sort of, interest rates. So, y'all hearing more conversation about adjustable rate mortgages, clients asking about them, or anyone know what those are? Yeah. Yeah. So, adjustable rate mortgages have made a comeback. I would draw a picture, but I'm terrible drawing, so when rates were really low, 30-year fixed rate, you get a 3% or maybe even a little less. There was really no reason for people to want to do an ARM. It's not like you can get a 1% ARM. The yield. So you hear the term yield spread, very very small yield spread. Well, as rates go up, that spread increases between fixed rates and adjustable rates. Okay, so there's more. And so obviously as rates go up, affordability is tightened for people because it affects their payment. So what are people more interested in? Well, how can I get a lower payment? Well, if you're willing to get a shorter fixed term on your rate, we can drop your rate. Just know that this rate in a number of years is going to start adjusting. It could adjust up, or it could adjust down, or it could hover around the same. But it's going to do something after a certain amount of time. So our company just reintroduced adjustable rate mortgages. We couldn't even do them for a long time. I think it was around the 1st of July, 1st of this month, we reintroduced them. And so we're offering again a 5-year adjustable rate, a 7-year, and a 10-year. Okay. And you see like what and I'll write there. You might see something that looks like this, or you might see something that looks like this, or something like that. So the first number is always the number of years it is fixed. Now this might be on a 30-year mortgage, so your payments as if it's a 30-year term, but your fixed rate period is one of these three. You might see companies doing a 3-year ARM, but we don't have that. The second, any idea what the second number might be?
When it goes up again? Or
Yeah.
again?
Yeah. Well, yes, sort of. So the second number is the frequency of when it can adjust after the fixed period. So this would be a 6-month interval. So every 6 months after the 5 years, it can adjust. Now, there are protections in place for borrowers. There are limits on how much it can adjust each time. And then there are lifetime caps on how much it can go up overall. So it could be kind of high. I haven't delved into yet exactly what all, where we are with all these, but what I am finding is we're talking to people who might be moving here, or they're buying that next house. I have a resident physician who is going to be here for 4 years. We're talking about 5 or 7 years. They know they're not going to be here longer than that, or they're starting a family and they know that this starter house is only going to be the 5-year house, something like that. So there are situations where these can be appropriate. It's just that borrowers need to understand what they're getting into and know the risks. We bought our first condo years ago. I did a 5-year ARM thinking that there's no way we're staying in this condo more than 5 years. Well, guess what? We were there for 7. What happened, we were fortunate enough to where that ARM, that rate started adjusting. Well, rates went down, and it started out at like 4%, and I ended up having like a 2-point-something% rate. It was phenomenal. I thought, man, I've kind of hit the lottery here with this thing. And then I kind of got nervous and decided to take it to a fixed rate and all that. So they can serve their purpose. Situations like that, you can win, and then I guess another reasons why we're seeing the ARM prices not be quite as attractive as it has in the past is that the investors on the back end are seeing that borrowers aren't keeping these as long. So if they're gonna give a lower rate than a longer term fix, they want to know that it's going to stay on the books for a certain amount of time. So that's something else that factors into the pricing. They don't want to make these rates too low if just gonna refi out of them or sell or pay it off. So,
So are they putting penalties in?
no, not penalties, but the pricing may not be quite as good relative to the fixed option, the longer term fixed option.
So they wouldn't probably like investors.
I don't think there's much of a difference there. You can get an investor arm. Price went out the other day. I think the spread we're seeing right now on arms is around maybe half a point or so, half a point to 3/4 difference from an arm to a 30-year. So, you know, is it worth that? To some people it might be, to others, you know. So I've had several clients we compared. At the end of the day, they say, you know what, for only this much savings a month, let's just do the fixed. So anyway, but they're out there, they're gaining popularity.
So that 7 1, I mean, after 7 years, every month?
No, I'm sorry. On the one, it's an annual.
Okay.
Yeah, every 1 year.
Okay.
The 6 usually means 6 months.
Okay.
Yeah.
All right, I was about to say, man, that's,
Right.
that is difficult.
Yeah. Yeah. I mean, there's all kinds of different.
Yeah, every week you don't set up like, all right, where we at?
Right. You know, historically, you would see mostly all 1 year.
Okay.
In this kind of volatile market, you know, we're seeing more of the 6 months adjustments. And I think it's just to mitigate the risk to the lender for taking that on.
Yeah.
So there's your arm lesson for the day.
Do interest-only loans still exist, or are they illegal?
I don't know if they're illegal or not. As far as traditional lenders like us offering them, I don't know of anyone that does. Although we're hearing more and more coming down the pike that, you know, 40-year terms are coming back, and, you know, for a while they had the 40-year mortgage. Yeah. Things tend to go in cycles, though, you know. Anyway, yeah. We think that another reason why arms and even, you know, having to talk to clients about a higher fixed rate than what they would like to pay. You know, the Feds later on this month will be raising rates again. We think, you know, 100 basis points, 75 basis points, something like that. That's going to be what in the next few days, 5 or 6 days. As the Feds continue to do this, and you all know this stuff, that, you know, they're going to probably send us further into recession if we're not already in one, right? And we think that that's going to give people an opportunity in the next year or two to refinance to a lower rate. So, you know, I know the consensus is rates are going up, but I think reality is as we, as the Feds take action to tamp down inflation by raising rates, we're going to go into a recession, and recessions always means lower interest rates on mortgages. Another thing to remember is that, you know, mortgage rates don't follow what the Feds do. So when the Feds say we're raising rates by 50 basis points, 75 or 100 basis points, that does not impact mortgage rates. You know, our mortgage rates are really driven by the bond markets, what's going on. You know, the 10-year Treasury is the best indicator of what's going on with traditional mortgages, Fannie, Freddie, FHA, all that. Now the banks might be more sensitive to that, and more concerns, consumer debt, commercial debt, things like that. So there's your econ. You got any other questions or see anything that the lender would want to know?
Speaking of all cash transactions, do you do like deferred lending or anything like that, or deferred financing?
The delayed financing? Yep. Mm-hmm. So within 6 months, they can pull all their cash back out. So if someone to win a house needs to pay cash for it, and then turn around and do a what's called delayed financing, they can do that and get all their money back.
How does that process start, or when does it start? So say we're working with a buyer, they're cash, they're under contract, month period, at what point they contact you at any time type thing, okay, let's get the ball rolling, I close on this date, and then in 6 months this happens, or is it I close on it, talk to you, then 6 months?
They could actually start that process even while they're under contract, just to start the underwriting process. But they could close right after. There's no the 6 month exemption is for 6 months, up to 6 months after the purchase. So they could do it anytime within that 6 months period. After that, there's they'd have to have a new appraisal done. Or it would be more of a cash out refi at that point.
Okay.
Yeah.
And with you guys, what's the loan to value that you can take out? 80%?
80%. And the pricing is as if it was a purchase transaction, which is nice.
Okay.
Yeah, as opposed to a cash out refi, which
Yeah.
is pretty punitive on the rate.
Yeah.
Seen some of those. I mean, it's not very often that most people who are paying the cash these days, they just want to pay cash. They don't want to have a mortgage.
As far as in-state or local, what are you dealing with?
I feel like probably half the clients I've been working with are out of state. That's kind of the feeling I've had. You think, does that feel right? Yeah.
I think it's our area.
Yeah, a lot of people
Yeah.
moving here.
Yeah.
We got a couple from Texas right now. We just started Brooklyn. Had some from Vermont. And got some from California.
Kansas City.
Kansas City. Yep. Just helped someone who works at the new casino. So we bring a lot of jobs. Yeah.
But even more when it gets done.
Yeah.
Mm-hmm.
Yeah. Yeah. A lot of exciting things going on here. Bringing people in. Well, thank y'all for having us.
Thank you, David.
Absolutely.
Thanks. And David's got new business cards for on Highland in the workspace area.
We got our address put on
He actually
there.
has an address now.
we're bona fide.
People are just trying to
Real deal.
Yeah, we got our signs up. Looks great at night, lit up. So yeah, come on down Oakland Avenue. Yeah, we're right next to we're Petite Suites and CR Gregory Insurance. We're on the left side.